Well, let me tell you what my hope is. I'm going to be talking about something that I think is extremely important to the first-time investor who has not, in fact, come to some sort of an agreement about what their lifetime strategy is going to be. Let's not forget that almost everybody in the industry says that the key commitment is to be able to stay the course. So whether you put all of your money in cryptocurrency, or you put all your money in NVIDIA, or you put all of your money in a target date fund, my hope for that first time investor is they're going to find a solution that they truly can live with for the rest of their life. Now, I know that's a big dream. And why is it a big dream? Is because I know whatever you do, to the extent that it's different than what Merrill Lynch wants you to do, or Goldman Sachs wants you to do, or Vanguard wants, whoever, that they want you to change to something they think is better. And of course, nobody knows what's better, but I can say this, that the probabilities of long-term success for the first-time investor is far better if they truly understand the ride they are about to go through. Because in theory, the first-time investor is talking about potentially 50, 60, 70, even 80 years of investing experience to face. And how can I, at age 81, sit here and tell you what the market's going to be like even 20 years from now? Well, the only hope I have is to be able to look back and see if there is information that seems realistic about the past. We don't want to be Pollyannish about this. We know it is not an easy ride. The stay the course ride is going to test most investors. And I want you to be hardened, ready for that. But I also want you to be in a strategy that has the probability of giving you a very fine return for the rest of your life. Now, that's the one group. And I know what's going to happen. We're going to put this up on YouTube. We're going to put it up as a podcast. And 2 to 10,000 people will either see it or hear it. But my hope is that some percentage, and I know it's a small percentage, this is the first time you've seen this kind of information. And you find it respectable, reasonable. Like I'm not making claims that are unrealistic. Now, there's another group out there that I think is this information is equally as important to, and that's the group that is coming up on retirement. And they have to decide, for example, they might be a target date fund investor, and should they be adding a little bit of small cap value to their portfolio? Should they, instead of having the S&P 500 only, have all four of the major U.S. equity asset classes? We know that as you see other parts of this boot camp series, and this actually was not designed to be a part of the boot camp series, but I'm probably going to sneak it in there some way because I think this information, while it is not up to date, I'll explain why in just a second, that this is as important as the fine-tuning tables or the distribution tables or the accumulation tables. So let me talk about what this is and also what it isn't. I already told the story on it's not up to date. This is information that is through the end of 2022. By the way, that doesn't mean anything different because nothing has happened since 2022 that would change these numbers significantly. Maybe a teeny tiny bit. And you'll see why in just a second. And the other part is it's hard to know how real the past is in terms of preparing for the future. I would have said 10 years ago that I could define the course the United States is on. We were on a path to something that looked like what I had grown up learning America is supposed to be. I'm not sure that's the case right now. I really am not sure. And I don't think it matters which party you come from, whether you lean right or left or right in the middle. I don't think people know. And so maybe there's something going on that we could say that the past doesn't matter, but the past does happen to include world wars of sorts. Well, at least one world war, if you go back to 1928, and our numbers do go back then to then, but other smaller conflicts, but that were still important wars, and a depression, and failed economic times when there were serious recessions, political upheaval. I mean, the story about the past is probably very similar to the story about the future, but we do not know what PE ratio, price to earnings ratio, they're going to put on earnings. There are companies right now selling for 100, 200 times earnings that 5 years from now could be selling for 10 times earnings, even though their returns, their earnings went up. We don't know. So this information I'm going to share with you is to help give it perspective. And that means, as far as I'm concerned, that we need to focus in on the parts that are hard to take and the parts that are easy to take. The hard to take ones are the periods when things aren't doing as expected, as desired, as wished. And then the other side of the coin, when the market just lays it out there on a platter and gives you returns you just had no expectations were going to happen. I am sure in 1975 that very few people would have ever guessed that for the next 25 years, the major market index would have compounded at 17% plus. And why do I believe that? Is because most people in 1975 who had money had some remembrance, some memory of what happened during the Depression when the market was absolutely terrible. And in fact, there was even a famous cover of a magazine. I think it was U.S. News and World Report. And on the front cover, it said, "The Death of Equities." And that was, I believe, in 1978 that issue came out because people were really concerned the stock market had the ride was over. No, the ride was just getting started. And by the way, that was true for large companies that are growth oriented, small companies that are growth and value oriented. Everything did quite okay. I think during that period that the S&P 500 compounded at 17, the small cap value index, as reported by Doctors Fama and French, had about a 22% compound rate of return. Problem is, nobody knew about the small cap premium at that point, which is what makes this information kind of it's easy to question because for so much of the information, and we're going back to 1928 in these studies, and some of you have seen these before, and hopefully I'll give you some new information if you have seen them before. But there is the big question. How meaningful is that information from the past? But I want to remind you, and I'll talk a little bit about this. I want to remind you that 29 to 38 had almost exactly the same 10-year return as from 2000 through 2009. Now, how they got there was different. It was much more volatile, the market was from 1929 to 38. For one reason, because not very many people were in the market. The market was not as liquid as it is today. Only, I think, at the time of the crash in 1929 and 30, that only about 10% of Americans had ownership of public stocks. And I can tell you that the Depression didn't encourage people to do a lot more investing. In fact, what we know is either people didn't have money to invest, or that was a wake-up call, what the market did, and they didn't want to have any part of that. As a matter of fact, you have to go into the 1960s until people who had been scared out of the market during the Depression were willing to come back in. It was hard for people to come back in the market because the memory was so vivid of what had happened before. And it's one of those things that makes it difficult for people to stay the course. So here I'm going to move forward. And as this cover page says, this is a story about 4 portfolios, equity portfolios. One will be a buy and hold on the S&P 500. One will be a buy and hold on small cap value. I'm not saying you should put all your money in either one of those. I do know a lot of people put all their money in the S&P 500 as their equity exposure. Very few choose small cap value as their only equity exposure. And if we look to the past, there's enough scary times that I think that's probably a good decision. Even when my wife and I gave our granddaughter money to fund her, right after she was born, to fund her Roth IRA when she earns enough to be able to do it, we split that money half between large cap blend and small cap value. We really want the history that she learns about when she's 18 to look in a way that she will say, yeah, I could stay the course with that kind of an investment. So let's look at the first of these tables. There are 4 of them. And the first thing I want to point out is what we've got here. And this, again, is almost always with these kind of tables. This is the work of Darrell Balls. And remember, I said it ended in 2022. It started in 1928. And Darrell looked at the 1, 2-year return, 3 years, took all of the 1-year returns and did the calculation, made them all 2 years, 3 years, 5, 10, 15, 20, 25, 30, 35, and 40. And the reason he did that is because you're going to see some patterns that are very, very important in understanding what the future could look like. And if you're an optimist, like so many investors are, you just don't spend a lot of time looking at the downside, but the goal here is to